This is Satya Prathuman of Cirrus Research. The latest issue of the Signals Report is just out. The Signals Report it's effectively an asset allocation report. It looks at our indicators in terms of stocks versus bonds, large versus small, growth versus value, and so on. The title of this report, Consensus 24 Slowdown Call, fuels end-of-year rally. A lot of this has to do with the fact that what we're witnessing now is a massive rally in interest rates. Inflationary expectations are down, and as of just recently, we're also getting a green light from the Fed in terms of short rates being cut. As a result, not only are higher multiple stocks rallying, but the broad markets rally. In terms of our asset allocation work, some of our critical components really support this more bullish stance. Number one, the asset class reading. It's an overweight equity still, even with the strong year we've seen. A number of the elements driving that are things like a stabilizing profit cycle. And now if we're correct that you end up getting really a real relief in the inflationary fears, at least in the short term, we should see much more of a tactical move on equities. Our size indicator had been overwhelmingly large. Now it's moving away. It's in a lean large, moving potentially towards a smaller cap bias. Importantly, we'll also see a broadening. So this is potentially one of the better cases scenarios where not only does the market stabilize, but we also see a broadening. And then finally, some of the other critical elements is the risk appetite model is not frothy. In fact, the reading, thanks to the sell-off a few months ago, has really driven the risk appetites lower. We suspect this will climb, especially when you think about things like seasonalities and the recent green light by the Fed. This reading represents the Cirrus risk score. The reading currently is in a below average level and an unusually low level. This typically is a contrarian indicator. It tells us that when defensive traits are abound, we tend to see a much more constructive outlook for equities, higher absolute returns. Ultimately here, the asset allocation model is currently at a 64% allocation equity, still quite high. It's not as high as it was at the start of the year. This model was in the 80% plus ranges for equities as the year started. However, even with the frenetic move in equities, especially the Nifty 7, this reading is still at a 64% allocation to equities, which is an overweight. Take a look at the report. It's generally constructive, and this idea of a broadening, I think, is real. As always, look forward to your questions. Thank you.